On to our panel discussion. We'll get all this assembled here in a second. As I noted at the outset, we've assembled a highly experienced group with a mix of perspectives, very much by design. I think you've got to broaden your viewpoints on what's driving credit, given all the extraordinary actions that have taken place really in the COVID period. With us today to help us sort through all of this, 4 panelists, which I will let them introduce themselves in a minute, but as an overview, Richard Berner, clinical professor of management practice in finance at NYU's Stern School of Business and co-director of the school's Volatility and Risk Institute. David Knutson, head of head of US fixed income product management at Schroders, the global asset manager. Oleg Melentyev, head of high yield credit strategy at BofA Securities, and Colin Teichholtz, head of markets at Element Capital, one of the most prominent macro hedge funds in the world. Gentlemen, thank you for joining us today. Interesting times we live in. Let me take a minute and allow each of you to talk about your responsibilities in a bit more detail and your background. Dick, do you want to start us off?
Sure. And thanks for having me on the panel, Van, and for joining this great panel. So one of the things that we do at the Volatility and Risk Institute is try to assess and identify risks in climate related areas, cyber, geopolitical risk, pandemic risk, and tie them into financial risk and look at the interplay among them. And obviously that's a big appetite for risk, but we're doing that with the aid of internal and external folks. We try to adopt an interdisciplinary approach. And we're only at the start of this, but we think by adopting such a holistic approach, we have a better chance of success and not missing things.
Interesting work indeed. Oleg, tell us about yourself.
Hi, everybody. So Oleg Melentyev, head of US high yield credit strategy at BofA. So I've been in this role for 20 years at this point, started under Mari Fritzen, who is a big friend, of course, of this venue, and Professor Altman. So I was lucky enough to learn from the best and kind of stay the course during these years. The market is very dynamic, so that I think is part of what keeps us all interested in this area again and again. Is like we've lived through several credit cycles during these years, but none of them is exactly the same. So it's always an exciting time here.
Terrific. Colin, about yourself.
Hey, Van, and thank you so much for having me on this panel. It's a very exciting time to be talking about what's going on in global economy and in markets. So kudos to you for your timing for having this. Look, I'm head of markets, as you mentioned, at Element Capital. One of my responsibilities at Element is overseeing all of our macro research and policy efforts. I'm hard pressed to think of a time that is more interesting than what we're trying to understand right now, both in what's actually going on in economies, what's going on with policy, and how markets are reacting. A couple of other things I'd mention. I do serve on a committee that advises the U.S. Treasury, the Treasury Borrowing Advisory Committee, and so kind of try to think as well through that lens and what's best for the U.S. taxpayer and funding the U.S. government's debt.
Glad to have you.
I would also mention that Colin's on our advisory panel at the BRI.
Terrific. David, tell us about your background a bit.
Yeah, David Knutson, thanks, Van, for this opportunity. I also think that these transitions are the best times to be an active investor, and it's great that we have a chance to talk about some of the opportunities and risks. I'm the head of U.S. fixed income product management now at Schroders. I spent some time here at Schroders as the head of research, and then before that, spent some time in research, credit research, quite a bit of time, and then even before that, I was in investment banking. So I've done different hats throughout time, and I think that's given me an interesting perspective.
Well, delighted to have you, and delighted to have everybody on the panel. So let's kick things off. And Colin, maybe this is a good place to start with you from a macro perspective. With a bit of luck and a lot of science, we may be moving toward COVID becoming endemic. Now, looking back, the federal response, massive fiscal relief, and a super accommodative Fed was larger than just about anyone thought possible. And here we sit with rates and currency markets well behaved and a booming economy. So beyond a bit of transitory inflation and supply side disruption, is there a cost to all of this?
So first of all, I like the embedded optimism in the question that we're moving into the endemic phase of COVID. And I hope that's right. I fear we're not quite there yet. Even as on a spot basis, we see COVID cases coming down in the U.S. For the last couple of months. As we go into this kind of colder weather period, I'd say my fear / expectation is we're going to see those cases make one more move higher at least. Obviously we're always at risk of the whims of the next variant coming along. But to meet your question where you posed it, I'd say the United States and really the globe, the developed economies around the world have spent an enormous amount of money to counteract this crisis, and that seems wholly appropriate. Whether every last penny was spent in the most optimal way, that seems pretty unlikely, just given the nature of how the crisis and needing to do that to shore up these economies. But Van, I'd say you have to argue that money grows on trees to think that there's no consequence to the scale of what's happened here. I candidly think the jury is out on whether this episode will turn out to, when we look back on it historically, will we look back on it maybe similarly to the way that economists look back on the massive spending that was undertaken during World War II, which once and for all broke us out of the lethargy of not only the Great Depression, but the enormous recession that occurred in 1936 and 1937. Until governments had to spend at a whole different level to meet a crisis, we didn't really have a solution to that malaise. So maybe what we've seen here is the jolt that was required to get us out of the secular stagnation stage that Larry Summers had talked about for quite some years. Larry Summers doesn't seem to be on board for that interpretation, but time will tell. On the other hand, sorry, it's let me turn my phone off. That's not good. The alternative possibility here is that maybe we've really spent beyond our resources, and that there's going to be a price to be paid for that, and that seems entirely possible. Whether it's just the allocation of society's scarce resources at a time when there are a lot of other critically important issues, climate change being one near the top of the list that we talk about a lot in the Volatility and Risk Institute, or whether it's some of the strain that is put on central banks and the ability to support, say, in Europe, the now even more elevated levels of debt in a country like Italy. The Stability and Growth Pact in Europe says that those economies need to strive to get their debt to GDP levels down to 60%. How do you get from 160 down to 60? And there's a lot of issues that need to be resolved. So I think the jury is out. I think that it's highly likely that there are unexpected consequences of what was probably pretty appropriate policy actions taken around the world. And part of what is going to be really interesting about the coming months, quarters, and years is evaluating all of that. And as an optimist, hoping that for the most part, this is more benefit than cost.
Yeah, no, I think we agree with all of that. And picking up the pieces, very much the theme of what we're talking about today. This is something that has got to be made up to some extent along the way, reacting to a lot of those unintended consequences. Dick, I want to go over to you for a second and get your take on the economic backdrop. The cross currents are powerful here, to say the least, and yet, Bloomberg consensus forecast is calling for real GDP growth of 4% in the U.S. in 2022, more than double the Fed's longer-term estimate. Very low bankruptcies on both the commercial and the consumer side of things, unemployment rate that could break through 4% by the end of next year. None of that sounds terribly disappointing, yet the Atlanta Fed Q3 GDP now read has fallen to less than 1% for the third quarter. Dick, how do you process all of this? How do you see the economy?
Well, thanks, Van. Let me talk both about the short run, which is what you're referring to, and maybe come back just a little bit to what the longer term issues that Colin and you were discussing a moment ago. So in the short run this morning, we had GDP reported on a preliminary basis for the third quarter at 2%, a little bit better than the 1%, but still a big step down from where we were. And I think that underscores both the headwinds and tailwinds affecting the short-term outlook. Many of them are pretty familiar, but I think it's important to summarize them. So among the headwinds, obviously, as Colin mentioned, COVID is still suppressing demand, in addition to being a long-term problem. It's not yet endemic because in many parts of the world, we don't have high vaccination rates, and people are not using the protocols that are needed to suppress the spread. It's also limiting the supply of workers in many areas, not just in the United States, but especially in emerging markets. And I think that that's really a factor that we need to take into account. We do live in a global economy, and growth in those emerging markets is at risk for a whole bunch of reasons. Their indebtedness, their lack of infrastructure, their lack of fiscal space, their lack of ability to deal with this crisis, among others. Second, we've seen global supply chain bottlenecks, obviously chip shortages and the impact of droughts on agriculture. They're limiting supply. I think that's going to limit growth as we look ahead for the next 12 to 18 months. Third, inflation is a problem. Excess demand and very accommodative fiscal and monetary policy have pushed it up. Personally, I don't think the risks are to the upside. That transitory is a word I would not use to describe what's going on with inflation right now. And home prices are also still running at a pretty hot pace, and that's limited housing affordability. And builders can't get the materials and supply. The anecdotes are legion. I'd be remiss if I didn't mention some other risks that Colin alluded to: policy, political, geopolitical, health, climate, and all the uncertainty around them. Uncertainty is not friendly to growth. Obviously, among the latter, we've got strong support from fiscal and monetary policies, but if they boost inflation, that's going to sap real incomes. As COVID subsides, parts of the economy are gradually reopening. I like to say to people that vaccination is and would be, if we extended it, disinflationary, because it would help us solve and address some of those supply bottlenecks. And consumers are flush with cash and wealth is rising, even though we've had massive support for consumer spending from the programs that have been put in place. A lot of it got saved, and so at least on a short-term basis, there are reasons to think that they're not going to collapse. So the bottom line is, as you indicated, there are a lot of cross currents. It's complicated, but relative to the 4% for next year that people are talking about, I'd take the under on that. Maybe 2.5 to 3 if we're lucky, and 3 to 4% inflation. Honestly, down from where we are now, almost 6, that wouldn't be a bad outcome. But that's with the Fed that has to raise rates faster than they currently expect. And then I share a lot of Colin's sentiments on our long-term issues. The challenges are legion. We need resources and space and resources to meet them. And, you know, we're spending them more quickly and using them up. And I worry about those long-term challenges right now.
Yeah, I think many people probably share those worries and concerns. Oleg, let's go maybe a bit deeper into the credit asset class for a second. And you know, we are looking at an economy that is normalizing, right? And careful what you wish for. As I mentioned at the outset, you've got decelerating economic growth as the effects of stimulus fade and the Fed pulls away the proverbial punch bowl. Credit markets remain priced for perfection, right? High yield is anything but. Yields hovering just above 4%. You heard Harry Mamaysky talk about our return expectation 12 months forward at being sub 2% in the asset class. Are investors adequately compensated for the risk? What's your view?
So I think kind of an easy place to start this conversation is just look at numbers. So the 300 basis point spread level, roughly where we are today in US high yield, is a level that this asset class has been unable to break through for the last 14 years. All-in yield, you just mentioned, close to 4%, pretty much at all-time lows. I think we bottomed out at something like 3.9 earlier this summer. So the starting point certainly doesn't look particularly exciting. Just looking at nominal numbers and not trying to overthink this, you kind of get to a conclusion that the asset class is priced pretty much at its best levels in a long time. The offset to all of this is that issuer fundamentals are improving really at a record-breaking pace. Just last month, high yield does have returned to pre-COVID levels. That's an aggregate for the market. We are still behind S&P. S&P is more tech-heavy, so there you have earnings growth close to 7% annualized. So arguably, high yield still has some room to go to just catch up with those sort of forward-looking indices on that scale. Defaults, of course, almost non-existent. We are annualizing close to 0.5%, which is an all-time low in high-yield defaults. And our estimates is that they're going to stay low, maybe not at extreme levels like we've seen this year, but nevertheless very, very supportive. And then lastly, the pace of upgrades, again, has broken records in high yield. There is no echo going on. So we have just reversed, over the last 12 months, we have just reversed 70% of all COVID-related downgrades within high yield. Again, remarkable in terms of how fast this has happened, but also tells us that there is probably a little bit more room to go, just because, as I mentioned, EBITDAs are already back. There's still some improvement on that side left. So we probably still maybe in the 8th or 9th inning of that upgrade wave. So you combine these two things together, you know, tight valuations, but fundamentals that are strong and improving, you get a picture that the risk reward is actually okay. We have this notion of liquidity premium, which is essentially you take your nominal spread, you subtract your expected credit losses, and what's left is essentially close to maybe 20th percentile historically, which again, it doesn't sound particularly exciting, but it also not at historical lows. And I think for a lot of investors these days, just given how few and poor other choices are for your capital allocation, people look at this asset class and they say, well, if there is a chance of me actually realizing anything close to that liquidity premium at 200 basis points, I'm in, because other options are just even less attractive than they are here.
Yeah, it's the other options part of the equation, I think, which is so relevant, at least to a lot of the investors that we speak to. David, maybe same question to you. How do you feel about risk and reward, and are they in alignment from your perspective?
So the short answer is no. I agree with most of what the other panelists have talked about, and I take a step back and I ask myself, you can't really have a sunrise without a sunset. And what the Fed did, they took away the natural balance, and that is going to be restored. And I think maybe it was was talking about how the adjustments for the small and medium enterprises haven't really had the adjustment. They will have an adjustment. When I say adjustment, I mean those zombies will die. COVID-19, the pandemic, it accelerated trends. And this acceleration has resulted in a lot of companies being left behind, although they don't know yet that they're done. So I think we're going to see increasing issues on Main Street. That's going to be a political question. So I think really the bigger question is, will there be a policy response to that? And I don't think there will be, because I just look at Washington and I look at politics and globally and here in the States, I don't see a consensus to address something like that slow kind of grinding burn of weakness on small, medium companies. So we're not priced in.
Yeah, no, I think that's, thank you for that perspective. I think it's for somebody who has to put money to work every day in credit. I think that's where the rubber meets the road, and I don't think you're alone with that view. A lot of people hold their nose, I think, and power forward, but I think 2022 is going to be a very, very interesting year with a lot going on, a lot of moving pieces, and we'll see if investor sentiment in the sector does change. So let's go back and talk a little bit, if we can, about some of the risks that are out there. Colin, if I go back to you, and from a macro perspective, credit returns are being driven by rate sensitivity, and especially in high grade. If the Fed hikes, it's a policy mistake. If it doesn't hike, it's a policy mistake. Which is it? From your perspective, how should investors think about the trajectory of rates over the next 12 to 24 months?
Sure. Yeah, that's I think the absolute essence of what's going to drive asset returns across probably all sectors. I think everything's been an interesting evolution. Not so long ago, we had President Trump berating the Fed and Jay Powell to lower rates, to make rates negative, et cetera, et cetera. And there's a lot of concern about the kind of political expediency violating the sanctity of the Fed. And I think that's become that balance has shifted a lot, in the sense that concerns about the elevated inflation levels that Dick was speaking about are now right up there with I think from a political perspective and a policy perspective, and in kind of in popular sentiment, that we need the Fed to control inflation as much as and to curtail the shortages of everything that are impacting virtually everyone in our economy, as much as we need to ensure that we achieve full or maximum employment, which is the other side of the Fed's mandate. So I think that there's been a wake-up call, a reminder that there's reason why we give the Fed a dual mandate, and that it's not only about stopping deflation, which has been really the issue at hand since the GFC, is how do we not fall into a Japan-like scenario. And now we're all having the kind of the wake-up call that elevated inflation comes with a whole lot of other challenges and issues. I think with that backdrop, it's extremely likely, unless there is some extraordinary change in the facts, that we will see interest rates rising. The Fed is next week going to meet, and they're going to tell us that they're going to initiate their tapering program. And, reasonable people, think that will the end of that tapering will be sometime, maybe on the, it could be as soon as the end of the first quarter of next year, maybe more likely the middle of next year. And then the Fed has made it pretty clear that they don't want to be raising rates while they're still doing QE, but as soon as they finish QE and perhaps with a kind of a polite rest period of 2 or 3 months, that they'd be very comfortable raising rates. And so I'd say my base case is that they do finish the tapering in the middle of next year, and then they start raising rates once a quarter, for the foreseeable future until they feel like inflation is where they want it to be relative to their target. I think that's it's going to be interesting to see how markets recalibrate for that. And I know when I talk to investors across really every asset class, the fact that rates are so low has been mission critical to valuations and everything from high yield to equities. To the extent that you look out the yield curve, the performance of the long end of the yield curve would suggest as long interest rates are actually coming down, not rising, in the face of inflation, in the face of the Fed tapering, and so on. Either argues that the market thinks that the Fed just doesn't need to raise rates that much to get the impact that is required, or that perhaps that the Fed or other central banks are making a policy mistake, as you alluded to. I think that argument's getting pretty challenging to make, and sometimes it's never it's always more fun, I'd say, for a central bank to be cutting rates and stimulating the economy. History is replete with examples of recessions being started by the Fed over tightening. My personal view is that in this instance, and kind of given the history and the sort of the way that the current Fed management is wired, that they're more likely to end up being a little bit behind than a little bit ahead, if I had to guess. And if that's right, it would suggest that not necessarily today or tomorrow or next week, but that over time there'll be a repricing higher of long-end interest rates, and I think that in turn has knock-on implications to all asset classes.
Yeah. So just a quick follow-up. I can't imagine anyone being critical of Jay Powell and the FOMC for communicating or over communicating, right? Everybody seems to kind of expect the same thing, at least in terms of the timing of all of this. Is there, what does a scenario look like where the market might be surprised? Are we behind a bit? Fine, I think we can probably catch up pretty quickly, but is there a scenario that you think we really have to worry about that the market is not expecting?
I think that's certainly possible, and we've seen examples of this in other important economies just in recent days. For example, I think I already mentioned the example with the Bank of Canada surprising the market and somewhat abruptly ending their QE program, and there being a very dramatic reaction in the front end of the Canadian rates curve. But I think that as the incoming inflation data continues to be observed and analyzed by the Fed and the Fed staff, if they become much more concerned that what Dick said is true, if this inflation, especially at these very elevated levels, is proving not to be transient, then I think that it's certainly well within the realm of possibility that they could further curtail or essentially accelerate the speed of the taper. And I think that has kind of the small effect of just taking them out of the market as a buyer faster. But I think that would be a very clear signal, notwithstanding all of their arguments to the contrary, that tapering and rate hikes are unrelated. They're obviously related, and if they accelerate that taper I think they'd be communicating to the market that they plan to start raising rates faster than what I just suggested. And when you look at what's priced into markets as of this morning, the market sees it as much more likely than not that the Fed will hike the first time in June. So the market is already kind of leaning in that direction. And I think it would be a function of data dependency, but that's certainly a possible surprise. I think the alternative surprise, kind of hard to imagine right now, but I think entirely possible, is this inflation turns out to be quite transitory. And if economic growth is disappointing, if the perception is that we're not at full employment and inflation starts to recede pretty aggressively, there's a school of thought that says the Fed might not tighten very much at all, and this could kind of go. We look back on this period as being kind of collectively confused by some short-term price data that was really kind of a one-off shift in price level, but not actually any harbinger of actual inflation on a long-term basis.
Yeah, no, I think those are the scenarios, right? A lot to parse apart there. On the topic of risks, Dick, let me go back to you with an issue that we've thought here at KBRA for a long time is the risk that's out there, and that's the U.S.-China relationship and its many facets. We're witnessing really a remarkable mid-air adjustment to China's economy in the form of the common prosperity agenda. Third quarter growth slowed below 5%, a number that, for those of us that have watched this for a while, is a bit alarming. Ordinarily reflects very healthy economic growth, but for China, clearly disappointing. Dick, what are the most consequential aspects to the China story from your perspective?
Suppress noise. There we go. I certainly agree that the U.S.-China relationship is the most important one on the planet, bilaterally right now. And I don't pretend to understand all the nuances of the common prosperity agenda. To me, what's going on in China looks like it's not supporting prosperity, but it's moving in the opposite direction. We've seen a number of things that the Chinese authorities have done that likely pose downside risk to their growth. In addition to the fact that China faces many of the same global headwinds that I discussed above or a moment ago. I think that we can list them. We've got the Evergrande effect, which is they've got a very heavily leveraged property market and the potential for disruption as the authorities try to rein it in. The authorities are making strenuous efforts in the run-up to COP26 to limit emissions, for example, by limiting coal imports, by shutting down steel production, which in China is largely coal powered. The authorities are clamping down on entrepreneurship in tech and fintech, and I'm not sure exactly where that goes. They may see it as a financial stability risk, but what they're doing right now doesn't seem to sort of balance innovation with safety and soundness. The ongoing tensions between the U.S. and China, if anything, haven't really abated with the advent of the new administration, and that could intensify. They could fragment trade and capital flows and make people think that I better reorient my supply chains away from China. I better diversify my business portfolio and think about what that means. So I certainly see downside risk to Chinese growth and to the spillovers from that into the global economy. And I worry that more generally, as we think about the transition to a net zero environment over the next few decades, which I hope we can achieve, that it's going to be a very bumpy transition. And I think what's going on in China illustrates that. In the short run, it means that we've shifted the balance of power towards the energy suppliers, not just China, but obviously with respect to Europe, to Russia, who has a chokehold on gas supplies to Europe. And I think that those geopolitical tensions are going to be with us and are going to create problems as we look ahead, even in the very short run.
All very useful insights to a story that is going to stay with us for a while, it feels like. Oleg, your turn. So from either your perspective, thinking through the high yield market and how important is the China story to you, and probably as important, how prominent is it on the minds of your investors?
So I think there is no other way to approach this question and this risk but to acknowledge that this is, we're talking about a reform and in some cases restructuring of the second largest economy in the world. So it has consequences, whether they're visible or not. It may be a question of time when more of those consequences are better understood. So I think it deserves all the attention on the part of investors and researchers and everybody else. Having said that, I think it's also important to keep in mind that it's the decision of the Chinese government to proceed with those reforms. So there is an element to this that they would probably do this for as long as their economy allows them to do it. And they certainly have a better read on what's happening with that economy than we do. So from that standpoint, I also keep this element in mind in that, they have certain agenda, they proceeding with it. Sometimes it's expected, like I think is the case with real estate. They've been trying to tackle that issue for many years. Sometimes it's less expected. Some other sectors like technology and maybe gaming to a certain extent. But directionally, I think people kind of understand what's happening and the extent to which it can continue to go. As it relates to real estate specifically, they've tried it many different ways over several years to curtail the growth in that sector. And so it looks like they came to this kind of final frontier where essentially it's going to be a reasonably painful restructuring process that hopefully will get them to a place where they're more comfortable with the size and the growth of that sector. We think there is really no realistic scenario where the government doesn't step in and kind of draws a line in terms of, this is where spillover stops. And so we think, for example, that even if, and probably when Evergrande restructures, they're going to step in and they're going to say, okay, suppliers are still going to get paid. Households who are waiting for apartments to be delivered still going to get those apartments. So again, the government support will be there, but it's probably that line is going to be drawn behind the backs of US dollar bondholders. So if you are a US dollar bondholder, I wouldn't necessarily count that line is going to somehow help you in this particular situation. And then lastly, I'll just mention that unintended consequences are always a risk. Again, I think you're describing this exactly right. This is a mid-year adjustment and it's always challenging. So what we've seen in terms of energy shortages, which arguably are partly a function of their own geopolitical decision to stop importing Australian coal, is a perfect example of that unintended consequence. So now they're scrambling to make sure as they go into the winter season, they have sufficient energy supply. It certainly is not happening on their own kind of time scale and conditions, but nevertheless, this is something to remind us all that those adjustments are not necessarily always going according to plan.
Yeah, David, how prominent is developments in China to you, and how you think about the value of credit? David, are you there? I don't know that we lost.
You're on mute.
Yeah, sorry, you were cutting it out. Can you still hear me?
Yes.
Okay, I'm back.
You're back.
Okay, China. So I think, just to quickly some of the other folks have talked about China and its policies, some of the stuff that's going to be happening with their shaky real estate sector. You've got a party Congress coming up, power outages. I still think COVID is going to pop up here and there, some lockdowns, but I really think the thing to focus on China and frankly in the United States is real estate and residential real estate, because that is what people really will get out to the streets about. I think Evergrande is an icon. And I also think that what someone, I can't remember which one said it earlier, but there are consequences. There are consequences. People, we've lived in an environment for decades now where the consequences have been declining. And I don't think people have fully understood the consequences of the slowdown in China and the popping of the real estate bubble. And I think we're going to come to understand that better. So I think it's very concerning. You know, when I think about what we're seeing right now, and the same thing could be said about the U.S. in regards to the SMEs, what I talked about earlier. Bankruptcies don't occur abruptly. They kind of creep along slowly. I think Hemingway wrote there's two ways to go bankrupt, very slowly and then all at once. And I think we're going to see that manifest in China, and it's going to spread over into other parts of the world. And foreign bondholders are going to be taking it on the chin. The small and medium firms are going to have the same experience here. You know, one thing to notice: this Friday, there's a payment due. It was originally due on September 29th by Evergrande, but this Friday, $45 million needs to hit those, you know, those lenders, or there's going to be some excitement. So I think we won't have to wait long, but yes, China is something that we spend a lot of time on. This has been occurring for the last decade. In 2010, things started to slow, and so I think we're starting to see the final act.
Yeah, I think you're very astute in tapping into some of these populist issues, whether it's housing values or the energy crunch that is happening in places. These can be unsettling, create some unrest, weigh on consumer sentiment, and those risks all point to the downside as we look at 2022. Colin, I don't want to go by this topic without letting you weigh in on this. How does this, what's going on in China, how is it changing the way you're thinking about investing globally?
I mean, China is huge. This is absolutely fascinating. You know, kind of the political transition. Obviously, Xi appears likely to remain in power, so in that sense, not a transition. But the policies that he is kind of putting his stamp on the country and on the party and on the economy there, it's, you know, I think just been super interesting. You know, a couple of observations. I certainly share, you know, a lot of this concern and sentiment about the property market, and you saw firsthand in the United States that when the residential property market, when people lose confidence in that can become very challenging to get back on sides, and can take many years, even if the government is very committed to trying to reverse that. I think that something we're seeing is they're trying to kind of create this distinction, walk this tightrope between we don't care about the bondholders, we don't care about the big over-levered companies, but we do care about the houses, we do care about the people having their homes delivered to them. They probably care about the 80 million or so party members, my guess is nearly all of whom own a home or more than one home. And you see this also with the tech companies. You're not necessarily against having the tech companies providing services to the public. What they're against is the billionaire founders becoming richer and having a bully pulpit. They're against external investors reaping outsized rewards. You know, I think this distinction is repeated, you know, again and again. I'm not in the camp that this makes China "quote unquote" uninvestable, but I am in the camp that you know, given the sort of like the mix of policies that they're putting into place, that you need to get paid more risk premium. You need to have lower expectations about even the most successful companies being able to reap unlimited profits, because what we've seen in sector after sector over many years is that when companies become very successful, They get cut down a little bit. They're allowed to make a kind of a normal profit, but not an outsized profit, and that's got to be in your modeling. The other observation I'd make here, especially with through the macro lens, is the extraordinary performance of their currency, notwithstanding the weakness of the clear weakness of growth there. I think in prior episodes, kind of we as a market would have had anticipated that they'd be weakening the currency, they'd be stimulating trade and exports as a way to shore up weakness in the domestic economy, consumption of real estate, and so on. Instead, what we see is a very gradual strengthening of the currency. That's a very different dynamic. They clearly want stability, and not only stability, but stability versus the dollar. And so as the dollar strengthens, they've allowed their currency to get even stronger against the rest of the world. And to be fair, the one part of their economy that's functioning particularly well is net exports, where they're both exporting more and importing less. So the currency is clearly not an impediment to that, and they may view that there's just limits to how big they can push that, given the scale of their economy relative to the scale of the world. So last thing I'll say is 2022 is a very big year for Xi. In October of 2022, that's when he hopes to get reappointed to the unprecedented third term. My guess is that a lot of the sort of self-inflicted pain is going to be a 2021 phenomenon. I think that when we turn in the calendar into next year and get past Lunar New Year and so on, he's going to want to have a very positive tone in the country. And my anticipation is not to say that all this stuff goes away or that the newly formed regulators suddenly get disbanded or anything like that. But I think maybe the rate of surprises will go down, and the emphasis on juicing growth might go up next year.
Yeah, that's a very interesting call. It certainly makes a lot of sense. All right, let's. I want to talk about some of the structural changes that have taken place in the credit markets. We certainly think about reform after the GFC, and we're never going to get it all right, but we know it's going to change, and a lot of that change has really taken hold in credit markets. So off the top of my head, we talked a little bit about this earlier today, the rise in the shadow banking system and the capital markets continuing to disintermediate banks. The loan market now is prominent in leveraged finance as the bond market. Cov Light now the norm clearly in the loan market. Dick, let's start with you. What on this list stands out, and are there things in here that from a policy perspective you think we're kind of on the wrong path and we've opened up some systemic risk possibilities here? What do you worry about in this list?
Well, my previous job, Van, obviously I was paid to worry about a lot of things, and I teach risk management, so I'm still doing that. But I would say all the above and more, frankly. Dodd-Frank and the rulemakings that came out of it didn't address many of the vulnerabilities, as you just alluded to, in non-bank intermediation and systemically relevant financial markets. Now, the pandemic shock, as we all know, exposed those vulnerabilities in treasuries, repo, and other securities financing transaction markets. We knew in 2014, for example, that the proposals for money market mutual fund reform were inadequate, and that was confirmed in March of 2020. And I think there are several good proposals out there to make markets more resilient, and a holistic approach to those, I think, is really needed at this point. And we've got to have the political will to do that. In addition, I think we've got risk concentrated in CCPs, and the prospect of central clearing of treasuries and CCPs, almost a $30 trillion market that we're going to move onto these platforms, not to mention repo. Their resilience to liquidity shocks, I think, relies on the benevolence of the Fed and other central banks, and we need to think about the governance and risk management and some policy changes there, and I've participated in that discussion recently. Leveraged lending, I think, is as risky or more so than when the regulators issued guidance 8 years ago. So, it's hard to see that based on what Ed and others have talked about in terms of declining defaults and a favorable economic environment. But the fact is, I don't think investors are getting paid for the risk, to be honest. And last, I would just note a little bit far afield from this that fintech and innovation obviously offer significant benefits, but also potentially significant risks. And the things I talked about before, climate, cyber, geopolitical, and pandemic risks, I don't think they're priced into markets at this point. Maybe pandemic is, but there's still a lot of things we need to learn about those to think about where the risks are.
Yeah, no, I agree with that. David, I want to, Dick talked a little bit about some of the vulnerability or inefficiency in the front end. I know it's something you're fairly passionate about. How do you feel about the risk in the front end and the vulnerability in markets, given that it all sort of rests on the, the pinhead of the front end?
Yeah. So I really, I focus on just a handful of things to catch the heartbeat of and to kind of look into the future. And one of those things is the front end, and it's repo, it's overnight, it's pretty boring. You don't expect to make any money, you just want your money back. And the front end, there is a mess right now on the front end. And frankly, it doesn't get really any attention because it is boring and it's arcane, and you start talking about reverse repo and these tri-party bilateral agreements. It just gets really, really dull quickly. But if you look at the desperate attempt of the Fed to save the money market industry that's going on in the front end, and it's an epic battle. And last week, frankly, the started to lose grip. SOFR, the new LIBOR, fell off the soft floor. I'm going to put that in parentheses because it went down to 3 basis points, and I know it's not a big deal. But if you start to look at who funds in that part of the market, and who, 60% of all the Federal Home Loan Bank paper is in that front end. And if you constrict credit to that part of the economy, that's another blow to Main Street. So keep your eye on the front end, keep your eye on prices, and keep your eye on real estate in Elkhart, Indiana.
Those are words of wisdom for sure. And thank you for reminding me that I have to pay attention to Elkhart, Indiana. Oleg, let me bring up one more elephant in the credit room, and that is, with the Fed overtly backstopping much of the credit market at the outset of COVID, there are those out there that believe that default rates are structurally changed because every time we head towards some sort of downturn, investors are going to expect the Fed and Congress to act and backstop credit that theoretically is the default rate and makes credit cheap, even at these extraordinarily tight spread levels. How do you think about the ongoing relevance and presence of the government backstopping credit markets? Has that changed structurally default rates in your opinion?
Well, I think we can tell with relatively high confidence at this point that it certainly has changed the market's mentality. So the market has seen the Fed take out that tool. The market has seen it using that tool, and the market now assumes there is a line somewhere in the spectrum of risks out there where the Fed will again have no choice but do this all over. So that's a premise. The Fed is pushing very firmly against this. You listen to Powell's responses to these types of questions, and he says, look, these were extraordinary measures used in extraordinary times. So that's it. To their credit, the facilities have only been used to a small extent, just in terms of actual capacity utilization there, and they were the first ones to go. So in other words, some of those facilities are still outstanding, but when it comes to corporate credit facilities, they were actually shut down at the first opportunity. So it remains essentially, I think, an uphill battle for the Fed to convince the market that they are serious about, this being used extraordinarily in COVID situation, and this is not something they're planning to use every time the market goes into stress conditions. But I think at the end of the day, the only way the market's going to believe it is by seeing it in action, that those stress conditions are not going to trigger the redeployment. The question on defaults, I think, is a little more kind of far-fetched. I don't necessarily think that that particular application has immediate long-term consequences, but we all see what's happening in Europe, right? European high-yield default rates have been below US high-yield default rates for the last 8 years. And I think most people would agree it's not because the European economy was growing that much stronger, right? It's something else. And what else is it? Well, it's potentially the ECB who's been much more proactive with its policies going all the way to 2015. And that's approximately the time frame that I'm referring to here. So I think this is part of the reason why the Fed is kind of watching this carefully and trying not to cross that line where the market effectively becomes over-reliant on its capacity to step in.
One more thing on the Fed's balance sheet. Thank you, Oleg, for that perspective. Before we head to Q&A, and I know, Dick, you might be tight for time here, but I wanted to give everybody a chance just to express one high conviction view and or non-consensus. There's obviously a whole range of things to talk about. So Dick, why don't I start with you? What do you feel very much or most strongly about, most passionately about?
Well, from a market perspective, I guess I'd say buy volatility, because I think we're at low levels and people are continuing to sell it and they've been benefiting from that. But at this stage, I'm a risk guy, and so I think some insurance is probably warranted.
Fair enough. Colin, what do you feel most strongly about?
I think that the whole discussion about inflation and whether it's transitory is actually misframed. I think a lot of what we're all focused on right now with supply chains and so on and so forth that's caused inflation to be particularly elevated is highly likely to get sorted out. I think, for example, we're going to have an oversupply of semiconductor chips by late 2022, early 2023, and prices in that sector are going to be falling, not rising. But I think that when all of the all that noise has cleared away, the kind of underlying inflation in the economy is going to be revealed to be somewhat higher than it used to be. And somewhat higher might mean that it used to be 1.7 or 1.8, which the Fed thought was too low. And we might find that it's actually now 2.5. And I think the Fed is then going to have a battle to actually push it back down to 2%. And they're going to be pushing back against things like persistent inflation in the shelter sector, in medical expenses, and a small, not a big, but a small resurgence in the transmission between wages and prices in the Phillips curve.
Interesting. Very interesting perspective. Oleg, what's your high conviction view?
So I'm with Colin on this one. I think the market essentially at this point is, I would say it's not that it's overhyped. We're obviously seeing very unusual inflation backdrop, and it's raising a level of concern, duly so. But what I think is where the market is running ahead of itself is it's somehow assuming that just because it happened between 2021 and 2020, it is supposed to happen in 2022 and in 2023, and those are, I think, very far-fetched conclusions. So inflation is higher. It's certainly, the impact of pandemic looks like it's going to have a prolonged impact on inflation expectations. But you look at TIPS, and TIPS are pricing in almost 2.7% inflation before this morning. Of course, they came down on that GDP report substantially. And so I think, if anything, the element of surprise in the near term could be on the downside, just because, again, the degree of market sort of agitation on this topic is pretty high.
David, your view?
Yeah, I always terrible to go after everyone because I'm like, well, I've got this idea. Unfortunately, I'm going to saddle up with everyone else. I just think that, you know, I think someone once wrote that when God created man, she overestimated her ability. And I think what's going on right now is the market is overestimating the ability of the Fed to land this economy in the face of slowing growth. I mean, I look at the GDP now thing falling down to 0.5%. I think right now there's a probability, maybe a higher probability, that we could have we have a negative print next year instead of a rate increase. I think that you know, I think also that, you know, Dr. Powell is the hawkish option now. You know, there's other options out there, and we're going to find out hopefully in the next week or two what they may be or may not be. But honestly, he is the hawk right now, and he's not really, you know, there's no confirmation yet that he's the guy. So I think sell. I like the buying volatility. That's clear. But I think sell some of the hawkish rate expectations. I do think we'll sit down ultimately at higher sustained levels, and I do think the Fed will be creative in finding new ways to you know, come up with new tests before they hike. So
yeah, well, David, you don't have to be the absolute last one to go. I'll weigh in with a view of my own, and that is, you know, we've talked about, in fact, we've labeled it the great deceleration, right? So it's, you know, growing from 6% to 4% to 2%. The behavioral aspects to that adjustment, I think, are very real. And when you mix in an energy shock and the housing market being less affordable than ever, and higher prices for your average American family, I think all of that is going to weigh on sentiment in ways that we've forgotten how those things affect sentiment through much of 2020 and 2021. So I think I would share Dick's view of risks to the downside from an economic growth perspective. I think we've all gotten a little too used to what life with a whole lot of stimulus looks and feels like. So with that, let me bring the panel to a close. We've run over a bit of time here. Let me check to see. I think there's a whole lot of questions that come in, but let me bring in this one because I think it is an important one that we really haven't talked about, and that is the energy shock. And I'll open it up to anybody. You know, if we go back through history, energy shocks don't always predict recessions, but they're typically part of them. And so is this a newly discovered risk that all of a sudden we've got to readjust our models and thinking for, or is this something that, like a lot of other shortages out there, this is going to correct itself in 3 to 6 months' time? Anybody have a view on the risk of the energy shock?
I think it's going to last, you know, for a while. And I think that what I mentioned earlier, I think is important because there's a huge amount of sentiment that we need to really start the transition, even though there are a lot of forces that are moving against that. But I think that shareholders are telling, for example, we saw just the other day that Third Point is asking Shell to split into 2 companies, if you will, a good and a bad company, to make clear what, you know, its businesses are going to look like. People in the energy business are not investing in fossil fuels and traditional energy sources to help make, and certainly not enough in the greener sources of energy so that we can make this transition smoothly. So I think it's going to be pretty bumpy. And one of the things we know about energy prices and commodity prices in general in the short run is that they are not very sensitive to price, either on the demand or supply side. And that's really important. So if you get any shock that affects supply, it's going to have a big impact on the price. And you will see, as we've all talked about, you know, the consequences for that. And I think that there are going to be adverse consequences. They will have political spillovers, as I think some people have mentioned, and that's definitely a risk.
Anybody else on the energy side?
Yeah, I'll just jump in quickly, and Dick, I embrace what you're saying, and I think that as policymakers around the world at varying degrees and rates of change are trying to push towards renewable sources of energy and getting carbon down, it is I think inevitable that prices increasing on traditional sources of energy is supposed to be part of what's happening. That's actually helpful to the cause. But those prices don't cooperate it and do it in a very gradual fashion that makes it easy to manage gradually. Those prices are very jumpy for some of the inelastic demand reasons that Dick was referring to. And so I think we're going to learn a lot as we see, how do policymakers, whether it's in the UK or in Germany or in China, or perhaps someday in the US, respond to those price shifts, and do they just do a 180 like what we saw in China, where there's like, okay, we didn't mean it to be that big a move, let's buy as much coal as we can from Australia again, even though we're trying to punish those guys, or do they react maybe a little bit more like what we seem to be seeing in the UK, where they're saying, you know what, if the price needs to go higher, let's let it go higher, and if we need to subsidize people who are getting hurt by that, or industries that are getting hurt by that, we'll separately do a subsidy. But I think this is going to play out over the course. I think this is not for years. I think it's going to be for decades.
So one of the things, if I could just build on that again, without hogging the microphone, is, I was at the Fed in the 70s and lived through Arthur Burns, and I worry that people are going to start taking out the things that for which prices are going up, as Arthur Burns did, in an effort to say, well, the inflation really looks much more benign. What we've learned in the past 50 years is that when you have a shock like we're seeing now, and it could spread, is that starts to affect inflation psyche and inflation expectations generally. And then it creates a more deep and more lasting problem.
Yeah, I think we'll let that be the final word. We could go on, I think, for hours, but let me take a moment and thank all the panelists. A terrific discussion, rich in content, a whole lot to think about. Thank you one and all for participating today, and thank you all for dialing in and listening, and by all means follow up with questions. Happy to sort of kick them around and get back to you, and don't forget to check out all of our work on kbra.com. Thanks everybody on the panel, and again, thank you all for dialing in. Have a great day.
Great,
Thanks,
thank you.
man.
Thanks.